Now, before we get into segment 3, we'd just like to remind you, please like, share, subscribe. In this segment, we're going to talk about what is happening with the U.S. exports, what's happening in general, just because the physical market and the futures market are telling two different stories. And we just want to look at and really kind of dig into which one is right, which one will win out over time. Now, when we look at global refinery outages, you can see that they remain elevated. The expectation was at the end of December into January was to get closer to that white and gray line. And you can see that we've really flattened out and really gone sideways. That's going to continue. The expectation was that Russia outages were going to drop. They have to a point, but they're still well below seasonal norms. It's pulled some Urals off as you've had an increase in pricing, which they've increased some of their runs. U.S. remains low. And then as we talk a little bit later, China has also cut some of their runs in general, which is, again, we're seeing some of these run cuts. Then Europe, France is now facing a strike. We continue to see some of the upsets in the U.S., which is going to keep us, around this 82 to 83% utilization rate, which again is well below where we should be this time of year. So there's some aspects that we just want to touch on before we get into U.S. products because it's connected. So U.S. inventories capped a 7th weekly decline last week in China, dropping to 990 million barrels. But when we think about what does that mean, it's like, all right, well, that's still 16% higher than a year earlier. But when we look at, okay, well, what do they normally do? And when we consider what China normally does, they normally have they increase or they show what their refined products are. So when we think about this, it's like, okay, so China is 140 million barrels above 2019 levels, and that's just coming from Big Orion, which is a guy that I respect a great deal. And the problem with this is that it only looks at crude and not the situation with products, where China, unlike other SPRs, take into account its product stocks as well. So again, what is going to happen as we see the crude come down, become product in general, as we see demand issues for products? So again, we think that when you look at both sides of this, there's going to be an increase in general in China, which we'll talk about when we talk about floating storage. Now, we've also seen a shift where there's a significant amount of West African crude that remains for sale or unsold in the March trading program. We still have Angola that has cut prices again, and they sold one cargo. They still have 3 remaining on the spot side. And the problem is we have low demand, we have a high freight rate or freight rates going up, and we have backwardation. So again, these are things that are going to keep products moving into the market because you'd rather get into the market than to store it due to backwardation versus contango. So again, these are problems that we continue to see developing in the physical market with prices coming down, premiums getting cut, and we're just not seeing the same movement on the physical side that the futures are indicating, which is, again, where some of these differences are. But Shell bid for 12 cargoes in the second half of Feb, and it looks like when you think about what is Shell doing? Well, when you think about either Shell has lots of refinery shorts or is trying to squeeze the second half market, there's a lot of things happening right now because even though West Africa remains weak, we still have a lot of demand or a lot of purchases coming out of the North Sea and Europe in general. So it's really not, it's kind of a bifurcating market based on where some of the demand is. And when we think about West Africa, a lot of that goes to Asia, and Asian demand, it just is pointing to a much bigger problem as we go over the next few weeks. And based on what the physical market is telling us, there's going to be some of that pressure, just even though, futures obviously have found a lot of support on this optimism, but the physical market we think will win out over time. As you have products, product builds remain elevated, refineries remain under pressure just given where spreads are. So again, these are things that are going to keep some of this oil demand capped, even as we have Saudi Arabia taking the 1 million barrels out of the market. Now, with that being said, gasoline exports from the U.S. dipped by about 24,000 barrels, still kind of within this margin of error. Distillate had a little bit of an increase of 135,000 barrels. That's something that we think is going to be fairly sticky. But as we said, we don't see it getting back to over 1 million, just given the pressures on the ARB, where Europe, it makes sense to go from Europe to the U.S., not from the U.S. to Europe. So again, that's going to keep Disty, capped on the coast. Jet saw some demand. That's going to pare back as well. LPG remains elevated. That's going to be a strong market just given where some of the prices are. But then when we look at product totals in general, and you're seeing some of that support, but crude oil exports went up another 128,000 barrels a day. We were expecting to pare back, but we still remain at, they came in at 3.48 million barrels a day. That's a very strong number, which is really drawing a lot of this crude out of storage and into the open market. Now, this is also filling some of the deals that we had made before, because again, it's the physical market is a 4 to 6 week, 8 week market when you think about purchases and timing of loadings. So this is something that's getting filled, and as we look at Asian demand starting to come down, that still hasn't filtered into our system, which will take time, but we're starting to see that come through, which again gives us confidence that our 2.6 to 2.8 range is the right range to be in. It's just, again, the demand is there right now, and we're seeing some of those cargoes go out. Year over year, it's still up 70,000 barrels a day, which is still strong. So again, these are some of those positives that are helping pull some of that oil out of our market and then heading into some of those other markets. So when we look at exports, as we were saying, they were going to pare back a bit, but still remain above that 9-year average. That's something that's going to stay pretty consistent, where it'll continue to drift a little bit lower to the 9-year average over the next 4 or so weeks. But again, nothing too crazy, where we think it'll still remain elevated in general. Then when we look at distillate, we were saying that we were going to see a little bit of a spike, but it's still well below the 9-year average, the bottom of that cloud. That's going to remain. And the reason why, just looking at this as well, so just another quote coming from Bloomberg right now. When we look at India-Europe fuels, so arrival of clean products into Europe from India are set to rise this month. Right now, we're seeing about 280,000 tons of diesel and jet fuel coming over. That compares to January arrivals of 185 and 155 tons in December. So again, we're starting to see that walk up as some of the activity increases a bit in India on the refining side, but demand remains fairly capped in India, which is again sending it into the export market, going into Europe. Europe is importing it. Then we're starting to see some of those playing that arbitrage. Could it be turned around and maybe not end up in Europe? Sure, it could get sold along the way. But again, these are things that we're seeing in general across the physical market, with a lot of refined product still available out there. When we look at U.S. oil exports, again, we seasonally adjusted high after that dip right here. So we still think there's going to be a dip. It's still going to remain obviously above that 5-year average, just because we are still, it's better to compare it to where we were in 2019, 2020, just given the demand that we continue to see. So again, this is going to be a positive in general, where we'll stay at the top of the cloud. LPG, eking out that new all-time seasonally adjusted high. Again, something that we think is going to stay at and make new all-time highs, just given we have more capacity for export. There's more demand out there as LPG in general continues to make year-over-year highs, and demand on a global level. Even with some of the weather paring back a bit in Asia, we're still seeing a lot of propane demand, which will keep LPG flowing off the coast. Now, when we shift to Singapore, we had a little bit of a drawdown. We're still seasonally adjusted high, and it's still nice because it's a counter seasonal draw, which is a positive. It just when we see a lot of the products coming from India, China, some of those exports are being maintained. Some of that is being parked in India, some of that in Singapore, some of that is being moved into Europe. This is going to be one to watch as we continue to go and try to understand, okay, where is some of this product going to reside? Now, we think that instead of getting another spike higher, we think this is going to start to flatline a bit, just because we are seeing some exports move further into the European markets, which will keep some of the, avoid some of these spikes. But again, stay elevated, but go a bit sideways in general. And when we think about, what's happening across the OPEC market. So right now, coalition members exceeded their quotas by a collective 2.685 million barrels a day in May to December. This is not a monthly average, but again, a total of the monthly amounts. So what has to come out? It is equivalent to nearly 81 million barrels of overproduction and compares with the combined 2.461 million barrels of overproduction, or around 74 million that was from May and November. So December had another increase in overproduction that has to come out of the market. So when we think about what is the backdrop, so according to Argus, Russia overproduction is 719,000 barrels a day. They're not going to cut. Iraq is 626 million barrels a day. They're trying to cut, but they missed their targets, which is up from 604 and 578 respectively as of the end of November. So again, even though the shipments edged lower in January, despite some of the restrictions, again, we're still seeing that overproduction that has to come out of the market in general. And then when we look at where is the oil flowing, so we saw a dip into China coming from Saudi, UAE, Iraq. That is going to remain low as we see China slowing down a bit. But when we look at India was the one picking up the slack, and the Indian demand is the one that we think has a bit more stability over the next few, not just few weeks, but few months. Into South Korea and Japan, again, coming into the lows. We think that's going to persist just based on the economic activity we're seeing in Japan. South Korea activity is getting a little bit better, but the consumer's still sluggish. So again, we don't see this reversing in the near term, which will, again, even though we're seeing a bit more demand into India, we're seeing demand fall into China, remain weak into South Korea and Japan, which again is going to leave more crude on the water and in Asia in general. And when we look at a long way to go, Russia, again, is increasing oil production after those cuts, and they're increasing production even though they overproduced, which again, we're just going to be very clear, they will not be cutting and making up for those cuts. Just to highlight that just again. So when we look at India again, at the end of the year, you can see that they had a big drop in oil demand. That is for the year in general. That will obviously reverse. The question is going to be how much does it reverse and does it start to close the gap? And we think that there's going to be persistent headwinds. Not that it's going to be down 10%, but we think it, just based on where diesel is, diesel demand remains weak on a year-over-year, month-over-month level, which again points to some of those persistent problems going through the remainder of the year. Now, when we look at export impacts, so right now, just the preliminary for January, gasoline dipped down, but again, diesel remained elevated. And that's where, as the diesel continues to push out, we want to look at middle distillate, light distillate, which is why we think that there's going to be a problem in Singapore. Not that it's just going to remain elevated and there's going to remain more product to be pushed into the market. And a lot of that is going to have to try to find a home, which is going to push some of those margins down and again, put pressure on refiners in general. So then when we look at the aggregate, so when we talk about what is happening within Singapore, we talked about the total weekly fuel stocks, but let's look at light distillate. When you look at light distillate, we still remain at the elevated levels. We've normalized a bit. It'll be lumpy. We'll just stay at the top of this range overall just because gasoline exports have slowed, but so has demand, and we'll talk about that a bit more when we go through the Fujairah data. Middle distillate is the bigger problem. We continue to stay elevated, and now we had a little bit of a draw. Some of that went from Singapore and India into Europe. This is going to slow, and this is, we think, going to start to go sideways and still either make seasonally adjusted highs or just back within the top of the cloud. But again, this will remain some of those overarching problems. Now, when we look at Europe in general, we had some small draws pretty much across the board. Fuel oil had a small build, but when we look at gas oil going back to 2009, we're right around the average, and they're managing that average because some of the GDP numbers came in better, but now some of the leading indicators are showing some weakness, and we'll talk about that in segment 4 of the Econ Show, which is why they're importing from India, but they're exporting to the U.S., again, trying to play that arbitrage and maintain a fairly stable level of product. Gasoline came down again, even though we still remain down 30% or so of demand in Europe, but this is coming into the U.S. So again, it's just going from one place to one tank to another in terms of that storage shift, and this will start to end. Well, this will end up in the U.S. in general. So then when we think about, okay, well, what's happening in Fujairah? So Fujairah had total build. So the build was about 1.5 million barrels or 7%. To close at about 23.3 million barrels. There were builds seen across all three products slates, as you can see here, where light distillate saw a build of 67,000 barrels or 1%, up to about 7.3 million, holding above that 7 million barrels. And the problem is the East Suez gasoline market was finding some support, but when we look at the U.S. RBOB Brent crack, which was outweighed some of the bearishness. So again, we're seeing some of those movements as some of the arbitrages have opened up into the U.S. Again, supporting some of that flow coming into the U.S. markets and some of those imports. But when we think about the regional demand remains a problem. So localized lockdowns have increased in Asia, they're persisting. Malaysia specifically is extending its second movement control. You're seeing restrictions within the Middle East in terms of movements. So again, that's where we're getting that other side, where some of the flow is coming from storage into the market and into the Americas, and demand locally is remaining weak. Middle distillate rose 671,000 barrels to 5.2, up about 15%, which is the highest level. And it's the highest level, and the first time it stood above 5 million since last year. Again, these are quotes from the S&P analysts, which I think have been spot on in general. The gas oil market east of Suez was finding some support, but the regional balance is expected to tighten as surplus barrels make their way out of the region on new build vessels as suppliers take advantage of cheaper freight rates on some of these different components. Again, this will end up in Europe. This will end up in the U.S., which is why we're seeing the product kind of moving around, trying to find a home, putting that weight on just where the product demand is and where the product pricing is. So when we look at heavy residuals, they had an increase of 785,000 barrels, up 8% to about 10.8 million. Bunker market saw sellers. They were trying to move product. Again, this is going to remain weak as we see weakness in the export market, which we'll talk about a bit more as we go through the econ show. So when we look at what have we seen so far, so March remains slow, and that's with a drop down in Nigerian flow. And that's why Nigeria is cutting some of the loadings, because they're just not selling what's out there. So why are you going to maintain this? You still are struggling to sell February. So we think February cargoes are going to slip into March. Again, speaking to some of the pressures, we're already seeing some of the softness where they're starting to bid below OSPs. So again, that is an inherent problem, as the official selling price is kind of that starting point. You can trade kind of above or below based on shipping, based on competition, and we're seeing things cross below OSPs. Urals were trading at a premium. They're now starting to trade at, again, still a premium from where they were, but you're starting to see some of that weakness in the physical market even come into the Urals, which was flowing into China and India to make up for the loss of Saudi Arabia. So again, we're starting to see some of that softness that remains. Norway is holding about 1.6 million. Libya slowed down a little bit. So right now, this not all of it is reported. We think that they'll be above 1 million, but they're not going to be at that 1.1. Again, we think it'll be something closer to November in terms of some of those levels, just because they had some downtime for work. You had some political strife with some strikes and guys wanting to get paid. So again, some of those things will come into it, but those will remain elevated in general, especially based on where it was in September and October. Then when we look at the Mediterranean, that remains fairly stable. But again, Norway, North Sea, Med continues to see some of that flow through. So when we talk about some of the backdrops before we show the data, so Iraq missed its own target to slash oil output to a 6-year low and make up for the breach of the OPEC quota. The group's biggest producer, after Saudi Arabia, they pumped 3.87 million barrels a day last month, only 10,000 fewer than December. So they have yet to make up again for where they should be. And then when we look at some of the exports of Brazilian crude fell in January as a rise in volumes to China wasn't able to offset a decline in sales to U.S. and European refiners. So again, we should see some of those imports start to pick back up from Brazil into specifically the U.S., not so much Europe at this point. And China took 74% of their sales, which is up 32% month over month. That's going to start to slow, and you'll see that turn and more of that come into the U.S. So just putting into context, where December was versus January, you can get an idea of how much wood they have to chop to try to make up for their cuts, which they keep promising, they keep swearing to, but again, we're just not seeing it in the numbers in general. So when we look at crude oil on the water, it's pushing back to the highs that we've been saying, as we had some of that crude coming out of storage and into essentially becoming mobile. Now, as we've had, we'll show an oil drop in transit. Crude oil in transit has slowed, but now we've had an increase in floating storage. Again, just in general, more crude is going on the water, even though we do have that drop from Saudi Arabia. We expect this to remain elevated, and we'll start to show you why. So here you can see oil in transit as trending still below that 5-year average. We think that oil in transit is going to really kind of hug the 5-year average just based on what we're seeing in the loading market. We had some come down from West Africa. We had some come out of Russia, but again, we've seen an increase in not only the U.S. but also Europe. So this will keep some of that oil in transit going. Crude oil floating storage, you can see that increase, but seasonally adjusted high. Took out the previous high from early Jan. It's not that it's going to continue to go up. We just think it's going to have a pretty steady trajectory, positive, where we're going to see more and more floating storage, especially really driven by the U.S. and in Asia at this point. But when we look at Europe, we have to appreciate that there, even though there was a drawdown in Genscape ARA crude total tank stocks, we saw the drop, but again, it's still making that seasonally adjusted high. And just based on the demand, some of the bottlenecks with refiners, now some of the other issues there, we just think that this is going to remain at the top of the cloud, and we won't really get back into that normalcy until we get into April. Now, when we look at time spreads, again, time spreads are telling you get it into the market. So here's why we continue to see some of those loadings, trying to avoid some of the storage, which, it's moving to, as even going back to the beginning of January, we're back at 29 cents, which is, again, going to push more into the market in general, even though we do have a continuation of, pressure in the Singapore market when you look at just general spreads. And this is just looking at hydrocracking, it's looking at hydroskimming, just in general of Arab Light, Dubai spreads. We just want to look at what are the different components, and you can see that there's just not much movement. Now, diesel sales at India's 3 largest big fuel sellers fell 5% to 6 million tons in January from a month earlier. So sales of diesel to the country's top fuel, again, that's fell 5%. So January, we said a drop month over month of 5%. But then when we're looking at it year over year, diesel dropped in terms of selling points of 2.3%. So again, we're still seeing the pressure on the year over year and the month over month. Gasoline sales were down 3.3% month over month, but we're up 5.9% year over year. So we're seeing some of these different movements where the slowdown is there as people kind of get back into their normal movements and normal activity, which is still above that year-over-year level. So gasoline remains the bright spot. Diesel remains the biggest problem in terms of that oil demand. Jet fuel, not surprisingly, is down 43.6% year over year, where LPG remains up 2.3% year over year. It's down 1.4% month over month, but again, we're still seeing that demand in general. So that's why we just talk about India so much, because India flows into Singapore in terms of some of the storage, and this is where we're seeing some of these issues with the product market. Singapore Dubai crack, hydrocracking, it rallied off the lows, but again, we normally see this kind of rally this time of year, and we're just not going to see that pop, just given where spreads are, where differentials are, and again, this is going to weigh on just general activity. Now, Urals has started to turn higher as we were talking about. Some of the physical pricing has come down a bit, which has helped some of these margins in general. Again, this is something that is going to be a bit lumpy, but when we look at half these grades are still below zero, half the grades are let's call it between $2 and $4. So this is a positive, but it's just going to dictate how are you going to use it. So here you're going to use it for hydrocracking. You're really not going to use it for an FCC. And then you're not going to use it for topping either. So again, there's going to be this differentiating market that we have to talk about, which is why crude grades matter. Crude quality matters because you're going to see these differences in these spreads, which we're seeing in the physical market in general, where some of the demand is there for some of the medium sweets. But again, it's coming from Europe because the medium sweets coming from West Africa, there's no real demand. So again, it's going to become to those movements. Now, when we get a bit more detailed on the floating storage, you can see that increase. It's the largest for 2021 so far. It's up 23%. We're now back to 107.9 million barrels in floating storage. That's up 23% in general from 87.5% last week. Asia was up 17%, Europe 65%, West Africa 54%, North Sea, Middle East. U.S. Gulf Coast was down small, but again, we think the Gulf Coast is going to increase. Now, when we look at what's heading into China, you can see that even though Chinese demand is slowing, we still have VLCCs and super tankers directing into them. So again, this is going to become more floating storage. And as we said earlier, Japan, South Korea continue to slow. This is the trajectory going up. Now, it's not going to continue on this slope, but it's just going to continue to grind higher as these boats essentially show up, and we're just not going to see that movement. We are heading into Lunar New Year, so there's going to be less activity at the ports, less activity in general of moving stuff through. That will put more on the water, so there is a seasonal aspect to this. But when we just look at Malaysia, South Korea, Japan, India, we're starting to see those bottlenecks, and again, we're going to see those increases in general, with crude sitting offshore. North Sea, as we talked about, had that shift higher. Based on the sales, this is going to come down, so we're going to go from floating storage, oil in transit. So the North Sea is going to hold to what we think is that 5-year average in general, which should see that drop. Now, West Africa, again, Senegal cut prices again for February. So this is now, we're on either the 4th or 5th price cut, depending on the cargo we're talking about. And we continue to see this grind higher. So Nigeria, even though they've cut loadings for March, they're still not moving product, and they should have sold at least a decent amount by now, just because they're the first to post. So this is one that we think is going to continue to go higher and defy kind of some of this drop. And this is going to be the one to watch when we're looking at how is the physical market pricing, where is the pressure overall. This is where we continue to see that pressure. Now, Middle East is starting to creep higher a bit. Again, there's nothing really to say one way. We think it's just going to go sideways based on timing delays. And it's going to come down to how much can Iraq pull out, and we just don't think Iraq is going to be able to pull out that much, as they appear to make a lot of promises but struggle to meet them. Europe is going to continue to drift higher, but with the space, and this is where we start talking about Genscape, tanks versus offshore. There's limited amount really in floating storage offshore, given there is some tank capacity. So we think Europe is going to continue to be below the 5-year average in general. And when we talk about China, when we look at some of these run rates for the state-owned enterprises still remain low. Call it 75% on average, which is well below where they should be at this point in time, where they should be at close to 82, 83%, really kind of, filling the void for what the demand should be from Lunar New Year, which we already have said is going to be down 30 to 40% versus 2019. Up 10% or so from 2020, but still well below where it should be. which is going to put pressure on just general activity. So independence on the teapot refiners in Shandong, you can see that they continue to head lower. Seasonally adjusted, still at the highs, but again, coming down from that 75, 76 level. And they're going to continue to be under pressure. They'll still be, we think they'll hold above 70, but the state-owned guys are going to try to, force them to shut down and slow down to open up some activity for them. But again, these are those differences that we continue to see. As when we look at what's China's Shandong crude stocks, you can see that we still remain, at the top of the cloud. We have about 41 million barrels in storage, and with more crude showing up, you can see how we're going to continue to see those builds. There's clearly more capacity as there's more refiners that are now in operation after turning on last year. Again, these are things that are going to weigh on just how much crude, because if we remember this, everybody was super bullish oil because China was buying. Well, China is now slowing, but yet nobody's talking about that because everyone's like, oh, well, they'll come back eventually. It's like, well, they're not coming back to the same level, and we'll talk about why in segment 5 on the economy show when we look at the economic underpinnings and the pressure that they're going to face, which is really showing up in fuel oil stocks, which continue to go higher. You can see that they're still seasonally adjusted at the highs, and obviously not at the highs that we saw in 2016, but we think we're going to continue to see this push up. And this is going to be indicative of what does activity look like within China itself, which is, again, why we think that there is a bigger story out there, and the futures market is ignoring a bit what's happening in the physical market based on the slowdown in Asian demand. So the Asian demand, it takes time to go through the system. So we had builds in products, we had oil refiners, we had refiners slowing down. Now we have physical prices coming lower because the demand isn't there. And even though China really bought about, let's say, 12 million barrels, which is up month over month from December to January, we're not seeing what we should be, where everyone was really excited when they were buying 14. And we kept saying, look, they're going to go away, not just because of seasonality, but also because of falling demand internally from a weak Lunar New Year, a rise in COVID, and a sluggish economy that is really starting to take hold within the country, which again is going to just mitigate some of this oil demand and is going to continue to put pressure on physical prices. At some point, the futures market should care. Clearly when we at like on the pregame show, we said when crude was 52, we were going to see 55 before we saw 50. Now we're here. Now we think we're going to have to start to see something to support some of these moves. But in the meantime, guys are going to hedge. U.S. production is going to be supported. And it's going to be a very interesting next few months, to say the least. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.